In today's episode, we are spilling the tea on AT&T. We'll be looking at their business models, so the different streams of revenue that they create and how their business works. We'll be looking at financials and metrics of not only them, but their peers. We'll most importantly be looking at dividends and my dividends regarding AT&T. And then we'll talk about how much I own. So how many of the individual stocks do I own in this whole phenomenon of T under 30. So we'll cover that in today's episode. But first, if you want a channel that's going to help you speed up your journey to financial freedom through dividend growth investing, Stately Investing is the place for you. So hit that subscribe button below and let's get started. All right, so if we take a quick look at AT&T's 2019 annual report, there's some key information in here that we should be looking at when we're analyzing their stock. And most importantly, it's how they're generating their revenue and how they're generating expenses, and also where they're going in the future. So if we look at this page here in the annual report, you can see the different segments and how they break out their revenue. There are four real sectors here. Communications, which is typically what you think of as the phone sector. So this includes AT&T Wireless and all of their mobile subscribers, and they break out in detail how many subscribers they have, etc. Warner Media, which is essentially Warner, HBO, any of the digital streaming platforms that they have, and how that business is breaking out into the movie business essentially, or the television business. Then we have Latin America. They break out that specific geographic region because they have several brands there and it seems to be a chunk of their operating business. And then they have Xandr, which is their advertising platform. So if we look at their revenues versus their contribution, right? So the contribution is revenues minus expenses, essentially. We can figure out their gross margins per segment. So first, if we look at communications business, that margin is essentially 22.6%. So how I got that number is 32,000 divided by the 142,000. So take this number divided by this number. And you can see that communications is the majority of their business. They even call it out here that it's 77% of their 2019 segment or total. And that is down about 1% from last year. And then if you look at Warner Media, so their entertainment and really their movie and television and streaming services, Warner is about 27.8% margin, so slightly higher than the communications business, and their next biggest segment, but pales in comparison to what they do in mobility and communications. But you can see that it's grown significantly versus 2018. So there's a big jump in revenue in Warner Media, and that probably has to do mostly with HBO Go and HBO Max. And then in Latin America, you can see their margin is actually negative because they're losing money in Latin America, or at least they did in 2019. Seems like they have been in the past 2 years as well. So their margin is about negative 9%. And then if we look at advertising, their margin is very high. It's 82%. So that's the 1318 over the 2022. And so that margin is 82%. And again, advertising is a very profitable business. Why do you think Google makes so much money? So this snapshot alone gives you a good sense of what they're doing and how they generate their money. My commentary here would be that it's very interesting that the Warner Media segment has grown so significantly from 2018 to 2019. I would suspect that growth has continued in 2020. I think the communications segment is interesting. It seems to be slightly decreasing in revenue each year, but overall pretty stable. This is their cash cow, right? This is the biggest part of their business. It not only includes, mobile, but it includes all of the landlines, all of the business communications. AT&T really has a kind of a stranglehold on all of the communications in the United States as far as landlines and kind of basic basic communications. But what's interesting here is that I think, their revenue might grow in 2020 or 2021 as 5G becomes more popular and they can charge higher prices for their plans. But I also think their expenses will continue to go up because 5G is not cheap to deploy probably for them, and just getting all of the technology out there to make 5G enabled as they increase the strength of their network throughout the world. So I think communications profit margin will stay pretty consistent. I think the Warner Media segment is the segment to watch. I think it's a high growth area if they can recover from kind of how they bungled the HBO Max launch, and figure out how to cut expenses while growing subscribers and subscriber revenue. I think that is a high growth segment for them. Latin America seems to be a dog segment for them, in that they are losing money consistently every year. It's probably something where they just have to keep operating in that region, but it's potential that they are decreasing that. If you look at their revenue, right, they are trying to get out of that segment, or at least they are losing share in that segment, and so something they might eventually get out of entirely. And then Xandr seems like they're actually increasing their advertising, and advertising is a very profitable business. So if that continues to grow, I think there's lots of growth there for them in those segments. So next we'll look at some financial metrics, particularly looking at their peers as well in the industry and figuring out how they look compared to their rivals. So if we look at the profile here of AT&T versus some of their rivals, and I'm just using the basics from Seeking Alpha, and I'm not changing any of the symbols, and I'm not using any of the paid information, because I know a lot of you guys are just learning out here and don't want to pay for Seeking Alpha in their pro version. So we can just look at the basics here, but these are actually pretty good comps. So if we look at Verizon, Disney's a little different, right? Like, we can't compare all of those metrics because they're in a different industry. I think Verizon's very close, and I think Comcast is a decent representative as well, considering they have some of the television assets that AT&T also competes with. So if we look at market cap, they're actually all fairly equal, right? AT&T is kind of sitting there in the middle, slightly higher than Comcast, but then lower than Disney and Verizon. Enterprise value, this is a measure of kind of their assets and their equity. Enterprise value is actually the highest here. Employees, all around the same. AT&T actually has the highest. And then if we jump down to valuation, so if we look at PE ratios and some of these other ratios, you can see how they compare. So let's look at the PE gap. So this is with accounting, so these are a little more reliable than the non-GAAP methodologies. We look at the PE ratio of the trailing 12 months for AT&T versus Verizon versus Comcast. It's actually higher than both, which is interesting, right? I would have suspected that it's actually lower. So it's pretty equivalent to Comcast, and somewhat slightly higher than Verizon. So that's interesting, right? The price to earnings ratio, for you want to look at the industry average and see whether or not AT&T is overvalued or undervalued given that ratio. But let's look at some other ratios that I think are important, right? Mostly the price to sales, and then price to cash flow. So price to sales, again, this is like stock price to the amount of sales that they're generating. You can see that AT&T stock price is much lower than the amount of sales that they generate compared to their rivals. So Verizon's at 1.88 and Comcast is at 1.86. So if we look at those two and consider that AT&T should also be around 1.88 if you thought that it was a reliable business and similar quality to Verizon and Comcast, then you would say AT&T is undervalued. If we look at enterprise value to EBITDA, so enterprise value versus basically profitability, or profits, net income, you can look at AT&T at 7.5, Verizon at 7.86, and Comcast at 8.95. Not a ton of difference here, considering their enterprise values and how much money they are generating in profit. Price to cash flow is another interesting one that I like to look at in addition to price to sales. So price to sales looks at mostly, your stock price versus your revenue, whereas this looks at your price versus your stock price versus your cash flow. So again, cash flow is important for dividends. So if we look at that again, AT&T looks undervalued compared to its rivals of Verizon and Comcast. The amount of cash that they generate compared to what they're priced at is significantly lower than Verizon and Comcast. So I would say based off of price to cash and price to sales, AT&T is slightly undervalued. I think the PE ratio is probably pretty accurate. I think Verizon's PE ratio is actually kind of undervalued compared to AT&T to Comcast. So if we look at some of the growth metrics, right, I always look at growth and profitability, which thanks Seeking Alpha for seeing all of this and putting it in one chart. You can see their revenue growth is actually down significantly, which is not good, right? But makes it, again, I think potentially a good time to buy. Their revenue over the past 5 years has actually been consistently growing. So this just seems to be a down year. Hopefully not a downward trend overall. But if you look at their revenue, it's been going up. Whereas you can see Verizon's is pretty consistent, right? It's pretty stable. It's not really going up or down. And then Comcast has been growing. If we look at the EBITDA, let's look at the 3-year here. Again, it's growing pretty consistently, which is what you like to see. Verizon's is, again, pretty stable, and Comcast is growing pretty well. And then if we look at net income, this is a bad mark, right? I think most of this negative growth here in 3 year has to do with a large amount of debt that they are paying off, which we'll get into in a second. And then if we look at assets, pretty good growth. They're growing their assets. Same thing with Comcast. And then let's jump into profitability. We talked about the margin of the different segments. I think the gross profit margin here is 54%. Verizon slightly higher, and Comcast is even higher than that. So the lowest of the bunch, which is not what you like to see. I think their EBITDA margin is also the lowest of the three, barely lower than Comcast, but again, not something that you like to see. Net income margin, lowest of the three, right? So I think these financial metrics and comparisons are really what you want to look at, and really showing you why AT&T is at a lower price overall. I think not necessarily unreasonably so. So I think this is sitting at some of these financial metrics show you that AT&T is sitting at that lower price for a reason. But then again, if you look up here at their valuation metrics, they're kind of undervalued, right? So it's a mixed bag on AT&T. So I think we'll jump into the next piece, which is dividends, and which is why most of you guys are here. We'll look at their dividend scorecard and move on from there. All right, so looking at the overall scorecard for AT&T, you can see that their yield is 7.0%, which is very good for a pretty stable utility type, entertainment type stock. 7% is a really high yield, which is mostly has to do with their stock price dropping. Their payout is about $2 per share. Their payout ratio, 65%, a little higher than we'd like to see, right? We like to see in that 30 to 50% range or so. But I think that payout ratio could come down again if they're generating enough cash over time. And then their dividend growth, right? So the 5-year growth rate, 2%, not the greatest, right? It's probably not really beating inflation, not something that we like to see with that low growth rate. However, their dividend growth has been consistent for 25 years. So that is something that we love to see. I think if we jump over to the dividend growth tab, we can see just how consistent they are at growing their dividend. And so this is a reason that people like AT&T in general. They are just committed to the dividend. It grows at a a stable pace where they are not at risk of not paying out their dividend and not at risk of not growing it year over year. They're not doing huge growth spurts because they're reinvesting money into the business. So it's not just a dividend cash cow, although right now their yield is very high. And you can see that again from the yield tab. It kind of, as their stock price has gone down recently, you can see this yield has jumped up significantly, potentially making it a good time to buy. So I think we'll jump over to my accounts and track exactly how much of AT&T stock that I have and the dividends that I generate from them. All right, so if we look at AT&T in my Robinhood account, you can see exactly how many shares that I have here. It's around 68 shares, almost 69 shares here. The price is currently fluctuating a little below $30, so $29.74. My average cost is right around $30, so $29.99, making my total return slightly negative, around $17. And my equity overall is around $2,000. So it makes up the second biggest portion of my stocks that I have in my Robinhood account. So let's jump back to my overall portfolio so you guys can see. So I have, around $16,615 there, and $2,000 of that is sitting in AT&T stock. So again, you can see it here, and it's kind of fluctuating for the day. So you can see that I'm pretty dedicated. Again, remember my Robinhood account is for the stocks that I think are undervalued at the time that I purchase them. So I'm making individual stock purchases, and hopefully they are going to eventually not only get me dividend returns, right? So all of these stocks are dividend generating, but also going to get me some growth in their share price because I believe that they are undervalued at the time and that I'm getting them at a value. So let's jump over to my M1 Finance account so you guys can see exactly how much AT&T stock I have there as well. All right, so if we look at AT&T in my M1 account, you guys can see that I have about 43 shares here. The price is a little higher. I was buying at $31.51. You can see that my return, therefore, is slightly more negative $77. And then my overall value is at around $1,300. So slightly less than my Robinhood account, but not too different actually. So overall, if we add the 2,000 or so from Robinhood plus the 1,300 there, we're at $3,300 worth of AT&T. Slightly over the 100 shares mark. So if that's again generating around $2 a share, we're just taking rounded numbers here, and I have 100 shares. That means I'm generating $200 a year from AT&T dividends, or $50 a quarter, which is not bad. Every time they pay out, I'm getting around $50 from AT&T. That's at its current value. I think I'll continue to invest in AT&T. I think the whole hype around T under 30, what you'll see on Twitter or what you'll see just in the news in general, why people buy AT&T under $30, is that 7% yield, right? You're starting to hit that 7% yield on a company that is essentially a combination of a utility and an entertainment company, and so a pretty stable and growing company. And so you wouldn't expect the yield to be that high. And so anytime AT&T drops under $30, you see this influx of buying, and myself included, right? So I wouldn't say that I necessarily recommend AT&T stock. There are some, everybody should do their own research. I'm not a financial advisor, but I believe that for me, AT&T makes a lot of sense. I think if they can transition their business to a higher proportion of that streaming service and that entertainment area and advertising, those two key growth segments for them with high margins, I believe that they can really focus on those and get even higher share prices. AT&T becomes not only a great dividend paying stock, but then becomes a growth stock as well. And then I know that recently AT&T has said they've committed to lowering their debt levels. So they acquired DirecTV a couple of years ago and paid way too much money for it. And so they had to take out a lot of debt basically to acquire DirecTV. And while DirecTV isn't a unprofitable business, it's not a growth engine necessarily, right? And so I know that management there is really focused on paying down the debt. And if they can do that and grow these other industries, I think, AT&T has a long runway ahead of it, and I will continue to buy personally. So hopefully all of this information has given you some viewpoints on AT&T. Leave a comment below on whether or not you like the stock, whether you would invest in it personally. And then I will see you guys again next week. Stay safe out there.